Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. On today's episode, we'll be taking a look at the state of private credit and venture capital investing in the Asia Pacific. We'll be joined by Vish Ramaswami. He is head of APAC private investments at Cambridge Associates. But first, we'll take a look at how markets are digesting the latest cabinet picks from President-elect Trump. Joining us now is Stacy. She is economic strategist and chairwoman of the UN's Global Digital Finance Committee. Frances, thanks for making time to chat. There's a lot to talk about. Can we begin by getting your reaction to the Trump victory and a lot of the choices for various cabinet positions that we've been hearing about?
Sure. I really thought that this election was going to be much closer, so I didn't see this Republican trifecta coming in. Now that it has, of course, equities have reacted quite favorably to it and not so much bonds. As far as cabinet choices, those are not all my areas of expertise, but I think that the Elon Musk choice and the Vivek Ramaswamy, even though they're not technically in his cabinet, is very interesting. That's the thing that I studied the most before the election and listened to various interviews from Elon talking about, drastic cuts in fiscal spending. I've even seen the number $2 trillion taken off of the budget floated around. And that's the thing that I think is most interesting, because the fiscal spending is what kept so much liquidity in the system while the Fed was tightening at a record rate. And that enabled the Fed to keep rates higher for longer without an attendant credit crisis.
So Musk and Vivek Ramaswamy will be heading the department known as the Department of Government Efficiency. And from what I'm reading, they're already beginning to crowdsource ideas on X for how to go about doing that. Do you have a sense of how they may go about it? The areas that might be obvious to you, that low-hanging fruit here.
It's hard to say. I'm more interested in how much they cut and what the rate is. Because if I was going to take this from a completely apolitical perspective, the rate of change in the reduction of fiscal spending, if you look at what's happening, you've got a couple of things that are inflationary sources in the system. You've got a potential of reacceleration of inflation, starting this November. And, you've got discussions of deportation, which could lead to some wage inflation. We don't really know the rate or how that's going to shift things, or how the massive immigration has actually impacted wages just yet. I don't think we have enough data. When you look at tariffs really increased government revenue. The last time he was in office didn't remarkably increase inflation, whether that's a pass-through thing. But now you're doing tariffs on top of, the inflation after COVID. So that's very interesting. And then, but then you have the tax cuts or the anticipated not raising of taxes. So you look at all the potentially inflationary things going on. Massively reducing the fiscal spending is at best disinflationary, but depending on how drastic it is, could be deflationary. And so what I have to say is Musk is smarter than I am. But I just have to think that he thinks of things mechanically. And I just really want to have confidence in how he's going to approach this. I don't think he's going to be, I hope he doesn't get too carried away, because there's a mechanical inflection point that could be drastic. And the whole thing about business and credit cycles, unless they've changed after COVID, is that when you add money to the system, as we did in COVID, you add debt to the system. And when you tighten, typically you take future liquidity out of the system. And when you have a credit situation, it's when that future liquidity hits a threshold where then you have a credit situation. The fiscal was able to stave that off, along with the private credit, making sure that it was refinancing when banks weren't lending. So that kept things from being written off the books, which is deflationary. And then you had credit cards adding a tremendous amount of liquidity to the system. And so if you go in and adjust any of those factors mechanically, you sort of risk hitting that threshold. And so since fiscal spending has kept us afloat, I'm very interested to see how aggressive he is and where he starts, and it's anyone's guess.
So as I'm listening to you, I'm thinking of what I will call the Humpty Dumpty effect, right? When you break a system like this, it's going to be very, very difficult after it's broken to try to reassemble it in a way that would be kind of functional again. Is that what you're really saying?
Well, that's a possibility. It depends on how drastically it's done. I think one of the most interesting things I listened to leading up to the election was Elon Musk did the All In podcast, which were some of his tech buddies kind of really questioning him about this. They were saying, are you going to take 1 or 2% out of the fiscal budget a year? And Elon said, we have a once in a lifetime opportunity to switch the operating basis. And he likened it to tech terms in that way. Switching the operating basis where government spending, fiscal spending accounts for an enormous amount of GDP into something where it becomes more private sector growth. And it just depends. And he gave all these examples from East and West Germany and North and South Korea. It's a very, very interesting podcast. I recommend anyone listens to it if they want to anticipate how he thinks about this. And again, it's not necessarily a good, bad, wrong, or right. It's how quickly and how disruptively you do it. And I know that there were some ideas floating around that with, government employees, they would give them 2 years of severance. I don't know how true that is. I don't know. It's hard to determine it, sometimes when going through X, what is rumor, what is not rumor, what they will ultimately end up doing. So it depends on how quick the switchover is. It's just like a diet, you change it too drastically, or I hate to liken it to this, but some of our liquidity stuff is kind of like an addiction. So if you have a guy who drinks a bottle of vodka a day, you don't want to cold turkey him off that bottle of vodka because that's going to put his system in shock. So
You're right about that. Where does this leave the Fed, though? I mean, today we heard from the Fed chairman. He was talking about the performance of the economy being remarkably good. It's really not sending any kind of sign that the Fed needs to be in a rush to lower interest rates. But you're describing a big unknown now, and it feels to me like when I'm listening to this that the Fed is going to be in an especially precarious position as a result.
Well, the Fed, I think what Jay Powell has done an excellent job with is I think he's given the markets tons of anticipation of what he's going to do. And I think there have been very few surprises, even just recently cutting 25 basis points with the possibility of inflation ticking up a bit, because that's what he projected. So that's what he did. And I think probably he's going to continue to try to keep volatility out of his decision making and out of his projection. As far as he'll tell you that he's completely independent from fiscal, there were some rumors that Trump was going to do some kind of executive order, where he would be able to sort of intervene with interest rate policy. Again, who knows if those are rumors or there's anything like that on the table. But yes, he's gonna have to try and compensate for what they do. And, he may be fully prepared if they drastically cut fiscal spending. He may know that is de facto tightening, and he may be willing to adjust monetary policy, both interest rates and potentially, again, asset purchases to compensate for that. But it's not an easy position to be in. And and he was asked bluntly if Trump wanted to get rid of him, would he step down? And he said, absolutely not. So there you go. Hopefully they work together and they work in coordination. And I do have a lot of faith in Elon Musk. I mean, you just can't argue with his results, and that he will study the system very, very carefully. He will understand the mechanics of the system, and hopefully he will keep that in mind, because, it's like having an internal combustion engine versus an electric car. Some things you can really revolutionize, but you still have axles and wheels. And I kind of feel like the credit cycle is still an axles and wheels scenario, just because fiat currency and the debt cycle mechanically haven't changed. We've been living under modern monetary theory, which is it doesn't matter how much debt or deficit you have, in essence, if you have enough liquidity to service that debt. But if you go back to, the fall of Rome or the French Revolution, those things have an endpoint. Ray Dalio is calling for that as well. So we remain in interesting times. I'm not going to make some big prediction because Murphy's Law, I won't be correct about it.
We'll have more with Francis coming up. I'm Doug Krisner, and this is Bloomberg. Welcome back to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. We're speaking with Francis Stacy. She's an economic strategist and also chairwoman of the UN's Global Digital Finance Committee. So we know that the APAC summit is happening currently in Peru, and Donald Trump really may be the elephant in the room. A number of speakers, from what I've read, have kind of danced around the issue of how Trump would shake up the global economic and political landscape. There was one point that I found particularly interesting made by Andres Velasco from the London School of Economics. He was saying that we are moving into a more protectionist world led by the U.S. And for countries in the Pacific Rim, in East Asia, and in Latin America, that's not very good news. Give me a sense of how disruptive Trump's policies could be to the global economy.
Well, again, from my perspective, I just think it depends on the rate of change. How does he ease out of one operating system and into another operating system? And I think he did some things. It's going to be interesting to see what's different this time around. We look at some of the things he did in 2016. It's hard to argue with the economy. It's hard to argue with, very tepid inflation. But it's just he's surrounded by a very different crew this time around. And he really does have a goal of shrinking government, and he hasn't been shy about that. And I don't know that was such a clearly enunciated goal the last time around. So does he mostly do what he did the last time around, or does he try to really take this once in a lifetime opportunity and drastically overhaul the system from, basically a system that, is liquid, largely dependent upon government spending, to a system that is mostly driven by the private sector? It's just so hard to say, but the disruption comes from drastic rates of change. And that's true of interest rates, that's true of volatility, that's true of mispricing in markets. And so that's the thing I'm most interested in watching, is how quickly they turn the ship.
So when I think of tariffs, you could make the case that this is really kind of a negotiating ploy to get more favorable trade deals. But a part of the thinking, I think it's fair to say, is that you're trying to encourage corporations to reshore their operations back to the United States. And maybe during the campaign, Trump began to articulate this view in terms of putting more American workers back to work in places like certain types of manufacturing. But we're living in a day and age now, if you visit China and you look at some of these manufacturing facilities, the degree of automation is stunning. So even if, in a best case, we were to get some kind of reshoring, does it necessarily mean that a large part of the labor market is going to be a beneficiary of this?
Wow, that is a really hard prediction to make. Of course, that is a lot of his voter base, and understandably, they were seriously displaced when we started outsourcing all the manufacturing. And I haven't looked at these numbers recently, but the interesting numbers to look at, we are primarily, we have such a disparity between services and manufacturing goods. And so I guess you could theorize that if you bring back manufacturing, you might be able to stabilize that imbalance a little bit and, hopefully hire some of these people that were displaced in the original cycle. Of course, displacement in the original cycle probably happened in a completely different generation, so it's hard to predict there. But as you say, one of the risks of trying to go backwards is not, allotting for a lot of the technological and automation changes that have occurred. And, it may be surprising when people think it's going to go back to how it used to be. And, it used to be 10 workers and now it's 2 instead of 10. So I'm not sure. And there's a bit of a skills gap. I rember I took a bit of a break from the financial industry for just a couple of years after the financial crisis. And when I came back, even, the technology around trading options, the spreads between the bid and the ask, the volatility, all of it had changed dramatically. And you have to relearn the system. So he must be, again, I want to give them some credit. Obviously the people that he, and I haven't studied all of the cabinet members, but Vivek and, particularly Elon, these are not stupid people. They really aren't. They've accomplished a lot. And Elon knows how to run profitable organizations, and he knows how to run teams, and he knows operations, and he knows how to get the best product out. He's efficient. So I definitely want to have every confidence that they are going to be looking at the things that you and I are discussing. It just remains to be seen how that's going to be implemented. And then, what pushback they get, what changes have to go through Congress, what changes can they do via executive order, and how quickly these changes are made. But I do think that some of these displaced workers may have an opportunity to get back into the workforce. And I really think that that's beneficial for America, because some of them have succumbed entirely to, drug addiction and other sort of unintended consequences of losing, that ability to provide and work in a productive way.
So one of the things that you have kind of caveated there, if I can use that term, is the rate of change. Let's imagine that it's accelerated, it's in the best interest of the incoming it's in the best interest of the incoming administration to move swiftly. Would that kind of change the way you're thinking?
Well, I will tell you, if Elon Musk phoned me and said, and wanted to talk to me about these fiscal changes, I would say to him, you have, which, not that he doesn't know some of this, but you have a GDP calculation. If you don't want to completely displace growth, you're going to have to fill in the fiscal component of it, with CapEx or something else, right? And if you look at the operating basis change that he's discussing, obviously, CapEx spending would go up, and that would affect GDP. Also, you have to look, they want to stop spending because the debt and deficits are so high. Okay, but if you stop spending, you're removing future liquidity from the system. And if you remove too much liquidity from the system all at once, you don't suddenly have enough liquidity to service that debt. And the debt doesn't go away. The debt gets written off, or it matures, or, and written off is, of course, a default scenario, but the debt just doesn't go away. You still have to service that debt. And our federal debt, I think it's $1 trillion every year to service it. So that's the discussion I would have. I would say, okay, if you want growth to remain high and you're going to remove fiscal spending, which the all-in guys guesstimated was around 40% of GDP when you take federal, state, and local together, and you take that component out, you're going to have to put something else there. The problem with the global financial crisis, which trading that was sort of my baptism of fire, was that so many loans failed all at once that they wrote those loans off of the books. And when you write the loans off of the books, they come off of the ledger, and it removes the liquidity that those loans provided from the system. And then suddenly you have a liquidity and attendant credit crisis. And that's why they had to do so many bailouts. And then they did so many iterations of QE and still didn't have inflation under those scenarios, is because the liquidity shrank so fast. So, hindsight being 2020, you can't just yank liquidity out of the system and not have that. So I would say to Elon, or Vivek or Trump, you're going to have to fill that gap with something, and taper it more slowly than you think. And the reason to taper it slowly is because you don't know where the threshold is. The Fed doesn't know. The Fed doesn't know where the neutral rate is. Nobody knows where that threshold is, because the money stock changes by every nanosecond. Every time somebody pays a debt, the money stock is reduced. And every time somebody, takes out debt, even on their credit cards, the money stock is increased. And there's so many variables happening so rapidly that not knowing where that threshold is, you risk really violating that threshold. And I think Jay Powell, in retrospect, has been good about not violating that threshold. And that's why we haven't had a recession, despite the fact that he's tightened, dramatically.
It's going to be interesting times as we look to the future. Frances, thanks for joining us and sharing your perspective. Really appreciate it. Frances Stacy there. She is economic strategist, also the chairwoman of the UN's Global Digital Finance Committee, joining us here on the Daybreak Asia podcast. Joining us now is Vish Ramaswamy. He is head of APAC Private Investments at Cambridge Associates. Vish joining us from Singapore. Can we talk a little bit about what's happening in China? We had some inflation data in the recent weeks showing, at least on the retail level, things are beginning to firm up in terms of prices. However, at the wholesale level, factory gate inflation in China remains in deflation. And this is, I know, a big problem for authorities there, particularly the PBOC. Give me your sense, Vish, on how you view what's going on right now in the Chinese economy.
My view is very much from the ground. hearing what private equity and venture capital managers are reacting and how their portfolio companies are reacting, it is optimistic. Whatever has happened since the government's announcements in September are seen as positive steps and as a huge sigh of relief. Many of the sectors that our managers invest in are not directly connected to the consumer sector. People invest in industrial automation, people invest in photovoltaic cells, new energy, and so on. So some of those sectors are in a different path. But on the consumer side, in the portfolios that we've seen, there has been tremendous contraction. Valuations have come down, mark-to-market valuations have come down because growth has not been as robust as it used to be. So I think some of the stimulation is necessary to bring all of that back, and it'll probably take a few more weeks or months for that to properly be seen in portfolios.
I'm wondering whether or not the threat of tariffs from the United States represents a big risk that you have to begin to consider when you're making investments in China.
It is. It is part of portfolio risk assessment, and we will have to weave it in when it's clearer. VC managers, for example, have already been planning how to tackle if President Joe Biden's executive orders and when it becomes law, or if the Biosecure Act becomes law. So people factor that in. And as I said, these are investments with a 10-year cycle or for a time frame in mind. There are two possibilities. One, it's something temporary for practical, commercial, economic, or other reasons. They are rolled back. The other is that they're structural, in which case businesses will find a new equilibrium. And especially VCs in a place where they are building businesses for the future.
Are you seeing a move to diversify out of China in a major way, particularly in a country like India, or is that happening a little bit more incrementally?
It is happening, but I hesitate to call it a like-for-like substitute. So as it happens, allocations to China private equity or venture capital have declined, but it comes amidst a global decline in fundraising and investment, even in the United States and Europe and elsewhere. So one thing is happening, which is investment interest fundraising for China private equity and venture capital has been falling for 2 years, 3 years straight. But at the same time, other pockets of Asia have been garnering interest. That includes Japan in the buyout space. That includes India in the growth and venture space. I don't know that if I would qualify this as a like-for-like replacement. I think it is happening because some of those markets intrinsically are becoming more attractive.
Are there themes here that you want to discuss and unpack? I mean, when I think a lot of what happens with VC money here in the U.S., it's more technology focused. Is the same true in the APAC?
Largely, but perhaps different kinds of technology. So as I was alluding to earlier in China, a lot gets done that is in consonance with what their long-term plans are. So energy transition, clean energy, green energy, clean energy, new materials, a lot of stuff happening in the EV space. A lot of attention right now is going into two areas, which is hard tech, which would be broadly speaking robotics and automation, which of course melds very well with artificial intelligence of various types. People are investing in large language models, but also applications that can be more consumer or enterprise friendly. So that's happening in China. In India, it's slightly different. There isn't the same semiconductor and AI stack in India at the moment. So we see a lot of evolution in direct to consumer in enterprise, both for India and for the globe. So typically businesses that have research and development in India, but go to market, typically in the United States, trying to position as global software providers. So the nature of VC is different in these two geographies. And then you have Korea and Japan, which have their own cadence and they have smaller markets, so to speak, in terms of dollars invested.
So when you identify a firm in which to invest, what is the typical runway that you give that company before you expect them to be airborne? Is it a 5-year time horizon?
So we would invest in VC funds or VC fund managers who invest in those firms. It depends. There are folks who would invest in a post-product market fit company, which is already generating revenues and perhaps gets to profitability or EBITDA in 2 years or 5 years, depending on how fast they want to grow. But some of the earlier stage managers we invest in might not see their companies even have a product for a year or two, and maybe another 5 or 6 before they generate substantial revenue approaching close to break even. So it depends on how early you go in the venture space. The earlier you go, the higher the chances that a particular company will fail, but the higher the chances that at least a few of those companies will be 50x or 100x returners.
You were speaking a moment ago about the challenges in trying to raise fresh capital in the current environment. What do you hear as a primary objection to someone perhaps being disinclined to put money to work in kind of the VC space?
We track a metric at Cambridge. It's called, we think of it as distribution yield. We look at the amount of capital that comes back at the end of the year, and we compare it to the starting NAV that a steady state PE or VC program has. Traditionally, it's been 20 to 25%. Today, it's 10 to 11%. So the amount of capital coming back has stalled. As you know, both in PE and VC, including in the United States, it has been a tough time to exit. For VC, its valuations are low. For PE, there's a large pool of undigested assets that were perhaps bought at high valuations and need to grow into that. So distributions have not come back from managers. This is a global phenomenon. And on top of that, people might be imputing geopolitical risk, which makes them hesitant to invest outside of their own home markets, especially for the United States, where there is a very rich and deep PE and VC market. So I think there is the global situation, and perhaps there is an additional overlay for some of the emerging markets like India or China, which are further away and perhaps seem more risky.
So if things in China were to turn as a result of a lot of the stimulus that we've been seeing from authorities in Beijing, do you think the climate could pivot as suddenly for VC money and maybe a little bit of PE?
It should in normal circumstances, but I also think it won't just be a commercial or economic decision. I think US LPs in particular will be looking at how the US government's regulations on them investing in foreign technology evolves. So as you know, the executive order is something that has happened. It grandfathers VC investments until the 2nd of January. And beyond that, there are some rules around notifications and prohibitions. They don't affect the LPs because they do not pick the companies, but they affect the GPs. And the LPs will have a look-through obligation to do some of the reporting. So I think there are other factors beyond macroeconomics, one of which is geopolitics. I think that is a factor, but it doesn't necessarily apply the same way to everyone. So folks, limited partners outside of the United States may have a different view of embracing a resurgent China if the stimulus manages to kick the economy back into gear.
Vish, we'll leave it there. Thanks so much for joining us. Vish Ramaswamy is head of APAC Private Investments at Cambridge Associates, joining us from Singapore here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia podcast. Each weekday, we look at stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, and the Bloomberg Podcast YouTube channel, or anywhere you listen. Join us again for insight on market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.